If you're retired before the age of 65, you need to prepare for massive health insurance increases in 2026. We've already seen insurers put in the rate increases, the request for 2026, and it is a big jump over 2025. Additionally, the premium tax credit, the enhanced premium tax credit for public health place insurance is set to expire at the end of 2025. So without any legislative changes, that's going to make a massive difference. Now, my name is Scott Caulfield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. Let's dig into the data. So just how much of an increase are we going to see for health insurance in 2026? Well, for marketplace insurance, also known as sort of Affordable Care Act or ACA insurance, they have recently put in their rate increase request. So we can see that the median increase for 2026 is going to be 18%. And thanks to this data from Peterson KFF, we know that the average increase is actually going to be 20%. So this chart is going to show you kind of the distribution. You've got 7 different marketplace insurers requesting 50% or greater. The vast majority are going to be anywhere from 5% increases up to 30% increases. So without even thinking about the enhanced premium tax credit, that's going to be a huge, huge jump. Now, how does that compare to last year? Well, if we look at the distribution of rate changes for 2025, the median increase was still a rather high 7%. The vast majority in 2025 increased between 0% and 15%, with the most common in the 5 to 10% range. What happens with Affordable Care Act insurance pretty closely tracks what happens in employer-sponsored health insurance. So employer health insurance increased between 6% for a single premium, and a family premium increased by 7% in 2025. So that compares quite closely to the increases we saw in what the Affordable Care Act insurance was on public health insurance last year. Best guess would be that employer-sponsored insurance is going to go up 18 to 20% in 2026. But this is a pretty big number. This doesn't even take into account the expiration of the enhanced tax credit. Analysis from that same KFF group said that the expiration of the enhanced tax credits will lead to out-of-pocket premiums for ACA marketplace enrollees increasing by an average of more than 75%. I'll say that again, more than 75%, with insurers expecting healthier enrollees to drop coverage. Now, there's a few things going on here. That enhanced premium tax credit, not only did it provide more tax credits to more consumers, especially low-income consumers, but it also capped the amount that higher income consumers had to pay. So for individuals with incomes over $60,000, I think it's $60,240, the amount that you would have to pay for your health insurance was capped at 8.5% of household income. That cap would go away. This chart shows just how massive some of these increases might be. If you are a couple in your 60s and you're not yet eligible for Medicare, well, I mean, look at that. So this one projects a couple with 85 grand, and they're talking about their health insurance going from a little over $6,000 a year to over $25,000 a year. That's almost a $19,000 increase. So there are some individuals who are going to be massively impacted by this. And, this could cause significant hardship or really change your retirement plans or your financial plans. This could also impact, say, a family of 4 at $130K or a single parent earning $50K. So much of the impact is going to depend on your particular financial circumstances and what you're doing. But if you're getting Affordable Care Act insurance, you're going to expect a massive change next year. The 75% change, I don't think that even includes the extra 18% increase. So we are looking at really, really significant changes for next year, something that you're going to want to take into account in your planning. And if you're planning on retiring before 65, you need to start thinking through what you're going to do for health insurance. Most people end up on the public exchanges, and it is shockingly expensive. And unfortunately, it's set to get more so. Now, some of the drivers of this, they're pointing to, one, as these enhanced premium tax credits expire, the thought is that a lot of healthy individuals are going to just stop their health insurance. They're not going to pay the extra premiums. The way that the whole health insurance market does work is healthier people subsidize less healthy people. Younger people subsidize older people. If these young healthy people roll off, the sicker people, the older people are going to pay more. It's going to be a pretty rough adjustment. And not only that, but you're going to see they're paying more for drugs. We've got the new GLP-1 drugs. We've got just improved healthcare across the board. We've got inflation across the board. We've got the potential impact of tariffs. We've got the uncertainty of all these things. All of that is adding into these big increased costs next year. If we look at what health insurance has done historically, we've seen that for almost 20 plus years, health insurance has been outpacing inflation. From 04 to 09, we can see we had an overall inflation of 14% versus premium increases of 34%. 09 to 14, it's 11% inflation, 26% premium increase. 14 to 19. Similarly, we had a 22% premium increase versus 8% overall inflation. And in recent years, we've seen real big numbers on the premium increases. So this is definitely a worrisome trend, especially if you're retiring before Medicare is an option. So take it into account in your planning. Appreciate it if you'd like this video, subscribe to my channel, and share with anyone you think would benefit. Thanks.